All right, welcome back. Today we tackle the questions that matter in 2026 and the macro forces behind them. At the start of every year, my clients tend to ask the same kinds of questions. Not what stock should I buy next and not what's the next trade, but questions like what does the global economy actually look like right now? Or what risks are markets underestimating? Where are central banks really heading? And how do you position intelligently without reacting to every headline? Today, I want to walk through those questions, but through a different lens. Instead, of making predictions, we're going to focus on five macro forces that will shape 2026. Because once you understand the forces, market behavior stops feeling random and starts feeling structured. Question number one. What is the global macro backdrop heading into 2026? When people talk about the global economy, they often assume everything moves together. In 2026, that assumption breaks down. The defining feature of the macro backdrop right now is divergence. And the primary driver of that divergence is artificial intelligence. AI is lifting growth, but not evenly. In the US, the impact is already visible, not through instant productivity miracles, but through capital spending. Data centers, compute, power infrastructure, physical investment. By some estimates, AI has already added roughly 0.5% to US growth, and that continues into next year. That's why US growth expectations still look too low. Now, contrast that with Europe. AI adoption is slower, investment is weaker, and there's little evidence that this gap meaningfully closes in 2026. So when clients ask about the global macro backdrop, the answer is straightforward. Stronger than expected US growth, weaker than expected growth elsewhere, and widening dispersion across those regions. The second question is often, how does China fit into the 2026 outlook? China is probably the most misunderstood part of the global picture right now. Yes, China has made real progress at the technological frontier, but the broader economy remains constrained by a deep structural imbalance. Supply continues to be prioritized over demand, capacity remains excessive, and household consumption stays weak, and policy rhetoric hasn't translated into a true policy pivot. If authorities were serious about shutting capacity, we'd see large-scale offsetting stimulus, and we do not. As a result, China looks closer to 3% growth, not the reacceleration many expect, and that likely persists into 2026. That imbalance also keeps downward pressure on prices and bond yields. China remains a deflationary force in the global economy, not an inflationary one. And that matters for global inflation expectations, also interest rates, and why fears of runaway reflation are often overstated. So question three, is the trade war really behind us? The short answer is no. The loud phase may be over, but the structural phase continues. 26 isn't about new tariff shockwaves. It's about adjustment. Tariffs already in place don't disappear. Governments have become dependent on the revenue. And one-year sunset clauses do reintroduce uncertainty later in this year. Supply chains continue to shift, and technology and capital flows face tighter scrutiny. And fragmentation quietly is going to deepen. This is where Canada re-enters the picture. Renegotiation risk, tighter rules of origin, and headline sensitivity around North American trade all weigh on confidence. And markets don't need escalation to reprice. Uncertainty alone is enough. So let's move on to question four. What should we expect from central banks in 2026? This is where expectations and reality are most misaligned. Yes, central banks are cutting. No, they're not cutting as aggressively as markets expect, especially in the US. Growth remains resilient, core inflation likely sticks closer to 3%, and the path forward looks more like gradual easing than a full-blown cycle. We may get one or two cuts in 2026, not the sequence markets have priced. Now, political pressure increases risk, but institutional independence likely holds, at least initially. Globally, the picture diverges. Europe and the UK ease more, emerging markets continue cutting, and Japan hikes, the outlier. The result is a relatively firm US dollar with pockets of divergence elsewhere. This is not a duration saves you environment. Rate volatility remains part of the landscape. All right, so question five. What could go wrong, and what do we hedge? Every cycle has a risk that doesn't announce itself. In 2026, that risk is fiscal credibility. High debt levels, positive real rates, rising servicing costs. There's no fixed debt ceiling where things break. Fiscal stress shows up when confidence breaks, often following political shock. Potential flashpoints exist across all regions, Europe, the UK, the US. We don't expect a full-blown crisis anywhere, but we do expect short, sharp sell-offs tied to fiscal nerves, just like we've already seen. That's why diversification, real assets, and inflation-resilient exposures still matter, even in a disinflationary world. Now, when you combine the questions investors are asking with the forces shaping the world, a clear picture begins to emerge. 2026 isn't about collapse. It isn't about euphoria. It's about uneven growth, structural change, and intelligent positioning. This is a market that rewards discipline, not reaction. So if this framework helped you think more clearly about the year ahead, share it with someone who's tired of the noise. And as always, stay rational, stay invested, and I'll see you next time. Thank you so much for listening or watching today, and please find us at helmfinancial.ca for ways to connect with my team. Information in this podcast is from sources believed to be reliable. However, we cannot represent that it is accurate or complete. It is provided as a general source of information and should not be considered personal investment advice or a solicitation to buy or sell securities. Raymond James advisors are not tax advisors, and we recommend that clients seek independent advice from a professional advisor on tax-related matters. The views are those of the author, John Helm, and not necessarily those of Raymond James Limited. Any investor should consult with their investment advisor to ensure that it is suitable for the investor's circumstances and risk tolerance before making any investment decision. Securities-related products and services are offered through Raymond James Limited, a member of the Canadian Investor Protection Fund. Insurance products and services are offered through Raymond James Financial Planning Limited, which is not a member of the Canadian Investor Protection Fund. Raymond James USA Limited advisors may only conduct business with residents of the states and/or jurisdictions in which they are properly registered, and Raymond James USA Limited is a member of FINRA SIPC.